Welcome to our mortgage industry update brought to you by the GLAR Affiliates Council. Today's presenters are Kelly Lee with Commonwealth Bank and Trust and Kelly Simpson with Hometown Lenders. They're going to talk a little bit today about some of the challenges facing mortgages right now and give an industry update.
So we're going to talk a little bit about pitfalls that come about with the mortgage process.
Okay, so I'll take this one. So one of the hot things right now that we're seeing is because of COVID, a lot of people have not been really maybe paying attention to their expiration dates on their photo IDs. And as you all know, that's a pretty important document. We need it for the loan process. And then you also need to have it for closing. So this has slowed some closings down because people didn't have a passport that they could use or didn't have their IDs updated. So when it's not necessarily something that you all have to make sure of when you're meeting with buyers, but it wouldn't be it would probably be helpful if you just checked with them. So hopefully their loan officer, if their loan officer maybe forgets to look at it until the end, hopefully you all have had a chance to maybe look at it as well. But just get them over to get their IDs done so we can definitely get to closing. So.
And I don't know if they still have the IDs by appointment only. So that was causing a little bit of a lull with some of my closings because they couldn't get in to get their updated ID on time. So.
Yeah, I know my parents expired. We were having dinner the other night and they said they didn't even realize that it expired like 4 or 5 months ago. And they were actually able to go to Middletown and get theirs done. I spent 2 hours in line at Bowman Field one day, even with an appointment. I still spent 2 hours in line. So they got in and out of Middletown in about, I think they said 15 minutes. So, but now Middletown has gone to like an every other week where they'll do the IDs. Okay, so you got this, Kelly?
No, you take it. It's everybody's favorite.
Okay. So one of the things that happened to 2 of my closings at the end of 2020 was I had some self-employed borrowers, and as a lot of people did, they filed extensions for their taxes. So we had till July because of COVID, then they filed extensions till October. And then what happened was they owed the IRS money that they were planning on making a payment arrangement with. Well, unfortunately for the mortgage process, if they want to make payment arrangements, that's fine, and we can still close, but they have to have made 3 regular payment arrangements with them. Well, the IRS is not speedy. So if you filed your taxes in October and knew you owed $5,000, you probably aren't going to get a payment arrangement made until 2021. So in both cases, my borrowers both had to pay off their tax liens at closing. So, and this is not anything we will ever see on their on their credit report. We'll never know that. The only time it comes up is usually when we do an audit, a 4506T audit you all have probably heard of, especially for self-employed borrowers. And on that document, it shows what they owe. So feel free to add, Kelly.
Well, I had a loan last year. She had a fraud by her accountant, and he was doing federal time, but the lien was actually against the organization that she owned. Oh. And it was some $500,000 odd amount. And like you were saying about with COVID, it just took forever to get everything lined up. Of course, the closing was delayed. And she, of course, was coming unraveled and frazzled because she thought everything was settled because he was doing time and that sort of thing. So I think having really good communication with your clients about any pitfalls that they're not even thinking about, because there were, I think, 3 other contingent loans behind this that had everyone delayed. So.
Okay, so Our wonderful COVID-19. We ran into some issues in early 2020 with people being, with businesses being shut down. So obviously we lost a lot of closings back then due to having to wait for people to go back to work. Now what we're seeing is people are getting sick. They're getting COVID, maybe don't have symptoms or anything, but they still have it. And so their employers are telling them you can't come to work. And so they might miss a couple of weeks. I have a couple of people who work for a transportation company right now, shipping company, and they were both sick, husband and wife. And so we have had to ask them to get, once they go back to work a full 40-hour week. So get a new pay stub, because when we did their employment verification, it stated that they were on leave. So it kind of caught us off guard. So then we went back to them and said, hey, we've just got to get a new pay stub that shows 40 hours. So if your clients get sick during the process, please make sure you notify the lender so that they know exactly what to be looking for in terms of getting the verifications that we need for the employment to make a loan work. So.
And on another note related to COVID, COVID and appraisals. So I recently closed an investment property where one of the 4 apartments had a tenant who had COVID, and he could appraise all 3 of the units, but not the 4th one. Luckily, the tenant was well enough to provide pictures and he was willing to take it. But if you're in a situation that it causes issues with the appraisal, that is another pitfall that could delay your closing as well.
Great. So the courts are behind. I actually was working with a client who works at the courts, and because of all of the things that happened in the summer of last year with the stuff going on downtown with the riots, and then also with COVID, they got rearranged a lot into different buildings, and they got a little behind. So a lot of filings are not being done immediately like we're used to. So any types of liens, any mortgages, an additional mortgage or something that the customer may have taken out. Maybe they took a bridge loan out and they're selling their house, and so maybe the bridge loan's not recorded yet. So there are some things there that are important to maybe just kind of check in with your buyers or even sellers and just see if they've done anything in the last 30 to 45 days that may not be of record yet.
Yeah, this will definitely delay the closings. I had one at the end of last year with the bankruptcy court. And of course, they thought once they had the contract and sent it over that it would be an easy, we would get something back in a few days. And it ended up taking our closing almost 60 days to close, simply just waiting on the courts to release the judge to sign off on the sale for the bankruptcy. And then with the courts, like you were saying, lien releases and that sort of thing. If the current lien holder won't provide our clients with like a copy of the lien release, then we have to wait till the recorded copy is available at the courthouse, which has been delayed 3 to 4 weeks as well.
And that's really affecting some divorces right now as well with family courts. I've had a couple of them. I'm waiting on one right now where the process, they turned in the paperwork because nothing's in person anymore. They turn in the paperwork and they wait. And I just texted my client, we're still waiting to close on a refinance, and she's buying out her ex-spouse. And we haven't been able to close yet because we're still waiting on that paperwork to get processed. So. Our favorite term, student loans. So student loans, everybody right now has the 0 payment because of the CARES Act. Everybody has been entitled to forgive the interest and not make a payment. Unfortunately, in the mortgage world, that doesn't really help. So we know that there's a payment that's due, even though it's not due right now, but we have to qualify people with some sort of a payment. Now, many of them who have income-based repayment from prior to the CARES Act, prior to COVID, we can still use those letters if they can obtain them. I've had a couple of clients recently that have sent me their letters that they had received prior to COVID. I have one right now that she has not been able to get a letter sent to her, and it's a $50,000 student loan debt. And in some loans, we have to count 1% of that balance against them in their qualifying ratios. In some loans, we can count 0.5% of that balance in the ratios. And then again, if they're on income-based repayment and they're doing a conventional loan, then we can actually count that income-based repayment plan amount into their qualifying ratios. So, we see a lot of people that graduate right now with a lot of student loan debt. I think the biggest I ever saw was 400,000, but it's not uncommon for me to see $70,000 right now in student loan debt, which is a $700 payment against them in their qualifying ratios. So we definitely, if they've had student loans, we need to address it before you start showing them property, because we end up having to count something.
And this is something that I encourage the realtors to talk about when you all are having your meeting with the clients. I recently went to a client meeting with a realtor, and we talked about it before we even started the process. So she can get it started with the student loan people. So by the time I get her application and that sort of thing, everything is in line and it runs a lot smoother.
Mm-hmm. Definitely. Hot topic again right now, especially with COVID, is self-employed borrowers. We know a lot of people struggled through 2020 with their income. And so both Fannie and Freddie and even FHA came out and said, okay, we've really got to kind of pay attention to the self-employed borrowers. And so I think for several years, we've not had to get a profit and loss statement from them in the middle of a year. We've just taken their prior years of taxes. Well, that changed in 2020, where we have to get their P&Ls to see, how they're doing, how they compare to the year before. And a lot of times, if it's substantially declining from last year, we may not even be able to use any of their income. But if it's somewhat declining, but not a lot, then we'll probably be okay. But in a lot of cases, a lot of borrowers, self-employed, don't do their P&Ls themselves, don't know really what they are. So we have to try to walk them through that process. And then in addition to the P&Ls, we have to get bank statements to prove, if you tell me you're making $5,000 a month in gross receipts, I've got to show some bank statements that show the consistency of that over 3 months. So it's become a lot of extra work for self-employed borrowers.
Yes, I ditto everything Kelly said.
You want to take this first, or you want me to go?
You go ahead.
Okay. All right. So a couple of things that happen that I see a lot, obviously with selling real estate, which, we talk about buyers, but with selling real estate, I get a lot of times where you've got a borrower, a seller, I should say, who purchased the property unmarried. You all probably know a lot of this anyway. And then they get married in the process, and then they go to sell the house, and they don't think that their spouse has to do much, which obviously everybody learns this. So the spouse has to sign the contract. I think it's 1 to buy, 2 to sell. I hear you all suggest that many times. So they have to show up for closing. They have to sign the documents, etc. Now, when it comes to buying a property, and let's just say we're splitting apart and we have married couples, most everyone feels like they have to include their spouse when they purchase another house. So they can't go buy anything until they're actually divorced. Well, that is really not 100% accurate. They have to have someone else buy with them, because in Kentucky is a dower state. And so the spouse has a dower or courtesy interest in the transaction that their other spouse is purchasing. But if Kelly and I decided we're both married, I don't know if Kelly's married or not, but if Kelly and I are both married and we wanted to go buy a house together right now, we could do it and not include our spouses, because Kelly and I would have that joint right of survivorship that would not need our spouses to sign off on it. So in a lot of cases, when I have a divorcing couple, they'll grab a parent, they'll grab a child over the age of 18 who's legal age to sign, and they will put that person on the deed with them in order to eliminate that dower or curtsy interest for their current spouse.
Changing source of funds. So a lot of the clients aren't aware of the fact that once we start the process, if they say they are using funds from their checking account, that's what we are processing the loan to. So recently I had a client who was going to take money out of her savings account, but midstream decided to go open up a HELOC and draw the money off of her HELOC funds, and didn't think that that would be an issue. So obviously it changed underwriting a lot because we had a whole new credit line that we had to add on, which of course doesn't always report right away and that sort of thing. And it had to be totally rewritten because the source of funds is a part of the underwriting process. So they can't, she didn't mention it to myself or to her realtor. So it delayed the closing by a day because it had to be re-underwritten because she changed where she was getting her money at. And then title issues, such as heirs and liens. So currently I have a loan. It was a father who passed, and he had 5 children who are on deed to the property. So when they signed the contract, everyone signed, but as title was asking for everyone to either come in or to let them draft a power of attorney for them, all of a sudden, all the heirs are not on the same page. So unfortunately, we can't just move along with the 2 that are cooperating. We have to have all 5 in agreement to get this loan closed. It's supposed to close on the 9th. They aren't in agreement. They haven't got the payoff sent over and that sort of thing. So possibly this is going to be a situation that delays a closing. And as you all know, the closing date is the most important date that we're working towards. So in this situation, if they decide they want to hash it out for 30 days and that sort of thing, it requires contract extensions, rate lock extensions, a whole lot of work on the back end that, the heirs probably aren't even thinking about. So did you have anything to add here, Kelly, about title liens and that sort of thing?
Yeah, I do. I actually had one that finally just closed, but I had a seller I had a gentleman who owned a home and passed away, and he did not have a will, and all he had were 2 young children under the age of 18 who survived him. And so this was in Ohio, and they started the process to sell the property. His mother did. And as we got along, and there was an estate attorney involved as well, and they forgot or didn't realize that they actually had to assign guardianship first for the children who were his heirs, and then the guardianship transfer the ability for the estate to sell it. And so it took us about 5 months to get that one closed. Thankfully, because no one was living in the home, they went ahead and let the buyer move in and rent from them for that particular time period. But be careful with that, because some loans require you to rent for at least 6 months before you can close. So don't just think that you can do this while this is going on. Definitely check with your lender first to make sure that your buyer is qualified to do that.
Credit usage after approval process has started. So I personally tell all my clients up front that we look at your credit now, but we're going to look at it again right before the closing. Do not go co-sign for a boat, buy a car, take out any additional debt purchase furniture that's financed and that sort of thing, because I don't think people understand that we base our loan approval on the information that we take at the time of application. Anything that changes, just like I mentioned, the HELOC that was added, any of those things change the dynamics of the loan approval. And I've seen loans, get lost because of debt to income issues, and that sort of thing. So anything there, Kelly?
Yeah, and actually one thing that I see that happens sometimes as well too is they could have a lot of debt, or they could have some debt that they plan on paying off. So we've verified their assets to purchase a home, and maybe they had, and I've just had a buyer just email me a few minutes ago. We have a $17,000 debt on his credit, and we've qualified him with the payment, but he just sent us an email and said, well, I don't have that debt anymore. I don't owe it. So it's good for us to know that now, because what would happen, we would do a soft pull prior to closing. And if that $17,000 debt now became zero, we would want to know where he came up with the funds for that $17,000 debt, in addition to the money that he needs for closing a transaction that we verified. So if that 17 was in the number that we were using for the house, then we would have been short funds to close. So it's really important that they even tell us when they make big pay downs on some debt. And we communicate that with our clients. As soon as we submit a loan to underwriting, we tell them, don't go get anything, don't pay anything big unless you let us know. But it's definitely, communication is important in this process, that the more they let us know, the more you all might hear and can let us know. We'll definitely keep from some delays on some transactions.
We hope you found this update informational and helpful. Thank you, Kelly Lee and Kelly Simpson, for sharing that great information with us. Be sure to register to attend our other upcoming industry updates. Just register through your member portal, and you will get a Zoom link emailed to you. We hope you found this update informational and helpful. Thank you, Kelly Lee and Kelly Simpson, for sharing that great information with us. Be sure to register to attend our other upcoming industry updates. Just go onto the member portal and register, and you'll be sent a Zoom link to join.